There's a world of hurt in the syndication world. LPs are pissed. And I think people are learning their lesson.
Yeah.
All these little questions are key before you write that check, because once you write that check, you've got absolutely no control over things.
Okay, a little different setup here for the podcast, Self-Storage Income we're doing. We're in the middle of the Limitless Conference Center. So, Mauricio, thanks for joining me here, man.
Always good to be next to you in a podcast, my friend.
Right, every week.
Every week.
And now you get to double up.
Yeah, I feel like we should switch seats since last night we were in the same position.
That's
here.
true. We really were.
Mix it up
we
a
were
little bit.
just doing this last night. So today, obviously, I'm bringing you on. For those that don't know, you are a syndication attorney. You specialize in it. You help my firm out as well as a lot of other firms. Why don't you tell people, though, a little bit about your niche, legal niche?
Yeah, I'm a real estate syndication attorney. So I represent real estate investors who are raising capital to go buy big real estate deals, whether it's self-storage, multifamily, mobile homes, what have you. And they need somebody like me, because when you're in that business of pooling monies from passive investors, you're actually in the business of selling securities, which I know doesn't make a ton of sense because you're just buying a self-storage unit. Like why is the SEC, the Securities and Exchange Commission, even involved? But their wacky way of defining what a security is basically includes any time you take money from passive investors where the returns are generated by your efforts. Like you're doing all the work, somebody just cuts you a check, then you're selling securities. And so you need somebody like me to make sure that you do it compliantly, because as you can imagine, the regulatory landscape of raising capital is significant.
This is an interesting time to be having the subject, because the last 2 years, especially in the capital raising world, that has changed dramatically. So why don't you talk a little bit about what you have seen and what your firm has seen over the last year and a half, how things have changed, because you do commercial real estate. So in the commercial real estate landscape, how have things changed on the capital raising side?
It's been a dramatic change since basically, I'm going to say June of 2022. So it's been just over 24, 25 months now. We had our highest volume month in June of 2022, meaning the amount of clients that were reaching out to us and doing a particular transaction. And then basically the second half of 2022, the transaction volume just collapsed. And it's not just in my world, not just in the real estate syndication world, but even if you look at the private equity world or the venture capital world, the exact same thing
Probably
happened.
even more.
Absolutely. Like, that was actually a little bit interesting. It was a little bit earlier. Like private equity started to collapse Q1 of 2022, and multifamily and all of that stuff was probably, like I said, middle of 2022, where we literally had a 60 to 70% drop in transaction volume, meaning there was just no deals going on because nobody really knew what these things were now worth, because with interest rates going up, it's not so much that they went up, because I think that was somewhat expected. It was just at the speed that they went up. I mean, they literally went from, the Fed's fund rate basically went from 0 to 5.25 in the span of 12 months, or I mean, it was a very short period, and people got caught off guard. And as a result of that, people really were, I don't want to say confused, but there's just really no price discovery, and especially in cap rates. They just couldn't figure out what is this thing I'm supposed to be buying? What is it really worth? And sellers still thought their properties were worth what they were worth, in 2020, 2021. You guys are coming in as the buyer and say, well, you're in la-la land. This isn't worth as much anymore. And even to this day, I think, maybe it's getting a little bit better, but to this day, there's still a pricing mismatch between buyers' expectations and sellers' expectations. They're not quite sure what the right price is, and that's where we are right now.
Now, what have you seen in the last, because from my standpoint, the last, let's say, 30, so I'm talking really recent, 30 days. As you know, I've been traveling around a lot and everything, but we have raised more money in the last 30 days than we probably have in the last year and a half combined.
Wow. Okay.
So, like, the last 60 to 90 days, we started to see some stuff thaw out, but it seems like now more capital is saying, all right, we're interested in it. The sellers too, funny enough, at this time have also been thawing out. One of our most recent deals that we got, we're getting at $39 a square foot. I bought an asset just 6 months ago that's a half a mile from that one, at 60, and we own 10 assets in that market. It's $80 to replace it. So we're also seeing, it seems like sellers starting to come to the table. Are you seeing it all? Is that trickled down to you yet?
Where I'm seeing it is actually on the sort of inbound, let's call it the inbound sales side. So I'm definitely getting a lot more calls right now of people looking to syndicate, whether it's a fund they want to put together because they realize, hey, it's time to get in, or even just general transaction volume. Now that's a leading indicator for me. So that usually doesn't translate till another, sort of about a month or 45 days. But I've also, from my perspective, I'm a little bit cautious because I've had that situation happen last year. Like last November, it looks like, transaction volume starting to pick up. And then December, and then it kind of went back to normal. So I'm curious. It's good insight from you as well to see whether that's something that's just a kind of a blip in the current cycle, or if it's now a new trend. And obviously, with the Fed's announcement that, especially today, we had the PCE come out, which seemed to be supportive that there is going to be some kind of a rate cut next month. That may be the turning point where people are realizing, okay, this is it, and so let's get in there.
During the last year and a half, 2 years, talk to me about what you've seen as far as deals go on. Are you seeing people, capital calls? How has that turmoil in the last 2 years, what have you seen there? Right now, financing for real estate is really hard, even for self-storage. The markets are very challenging. Live Oak Bank is a specialist in financing for self-storage, including SBA loans. They are one of the leaders in financing all sorts of deals and deal size. We trust Live Oak Bank for their specialty in self-storage, their unique approach, and how they help their customers go through the process so there's no surprises. That in itself is a testament to their exceptional service and support. So whether you're looking to acquire, build, or expand a storage facility, Live Oak Bank has to be number one on your list to call. Click the link below right now so you can experience the difference that a dedicated self-storage partner can really make.
There's a world of hurt in the syndication world. I always say that it's not necessarily a world of hurt in the actual asset itself. Like even commercial, like even multifamily, even though it took a hit early on, it's actually held up relatively well. Most of my clients are in the multifamily space. It's just the syndicators are really struggling because they went in there with some assumptions about how much their debt was going to be costing, what their interest rate was going to be. They even bought insurance on these things, rate caps. So they were kind of capped at some number. But those rate caps have expired. Interest rates went way higher than anybody really anticipated or pro forma. And now they've got to re-up of those insurance. And so now the banks are asking them to escrow some of these funds. So bottom line is a lot of these deals aren't cash flowing anymore. The debt service, the coverage ratio isn't there. And so people are forced to do something, whether it's put in more money, right? Because the problem is the whole idea in our world is that at some point you add value to the property and then you do a refinance, right? Yeah. And so what let's just actually background a little bit, AJ, because let's just make sure everybody's on the same page. Back in 2020, 2021, it was really getting difficult for folks to get traditional financing on a lot of these commercial deals because primarily the values had gone up very, very much, very quickly, the values of the properties, but the cash flow wasn't keeping up. And so the debt service cover, it was very difficult to get a loan at like 80% loan to value like you used to back in 2020, 2021. So people were forced to go and get bridged debt is really what it was. So they couldn't really do the traditional agency loan, what have you. They did short-term, really 3-year loans. They thought it was 3 years plus one, but it was really a 3-year loan with the thought that, hey, I'll just take the short-term loan. It'll bridge me to permanent financing, and I can then just refinance. Well, in order for that to happen, there has to be enough equity 3 years from now for you to be able to pull that off. And with prices dropping over the last 2 or 3 years, a refinance is just not in the cards. There's not enough equity in the properties in order to do that refinance. And so your options are either one, you can't get a new loan, so you have to sell it, but you're selling it at a loss. That's no fun. Or alternatively, you put some more capital into it. And so there's been a lot of capital calls. And it's really indiscriminate. I mean, you've had great operators, I think, that have had cash calls. And certainly with the vast majority of syndicators really being new to the game, they just didn't know what they were doing, bought really high, and they've got to do cash calls just because they bought it at some ridiculous price and valuation. So it's been interesting, especially from the LP perspective, because everybody's really been scrutinizing that cash call provision. I don't think anybody even thought about what the cash call provisions look like, and now obviously we're taking a close look at what the procedure is. Are people obligated to pay? But it's been painful for LPs for sure.
Yeah, it's interesting process because I think a lot of people, especially in the last 5 years, this was their entry into direct investing, into assets with operators. They'd never done that before. They'd done like the stock market, things like that. And a lot of operators also, it was their entry to investors. So I know it was ours. 5 years ago, we started, which we've been around for 20 years, but we only used our money ever. And so you have these new relationships and these new expectations. And I know that that can be confusing. And they see things very differently. Often now I have to sit here and think about, I have to trade my hats, right? Which I don't think about because I'm like, no, we just own an asset together. We own a business together. This is how it works. You know, I went through 2008. I've been through years where things got slaughtered, right? I've never lost a deal. I've never done capital calls or anything else, but we knew there were times where we didn't make money.
Okay.
To us, it's like, yeah, that's normal. Right. This is a normal functioning part. Revenues go up, revenues go down. These aren't ATMs, right? But there's a lot of people that when you've never direct invested, you've never owned a business, you don't understand really how that works. And when you read a OM, you see it and you say, okay, my average annual return is going to be 15%. And a lot of people are like, oh, that means I'm going to get 15% every year in my mailbox. And that's not actually how it works at all. Most of the time, that's just saying your total investment cycle, that's how it pays off, and that's what the average is. And so speaking to the mistakes that we made and talked about was the unrealization of something that I'd been doing for my entire adult life. That was normal for me, understanding everything else was not normal for other people. And that was their first entry to investing in. That had a lot to do with the internet, right? And a lot to do with people being first introduced, they could own assets. And I think I saw the friction between operators and LPs when things didn't go right? And how like operators in our industry, and that got even, I think, more exasperated when you had operators that hadn't been doing this and were either losing deals or doing capital calls, and there was a lot of friction there.
LPs are pissed.
Yeah.
You know, they're pissed because I think a lot of the syndicators are new. So last year I was talking about a stat that 70% of all syndicators had 3 years or less of experience. That was last year. It's probably not true anymore. But there's a lot of new people, so they don't really know. They don't have the experience of how to communicate with limited partners, how to manage their expectation. To your point, and so I've been very critical actually of a lot of operators because a lot of operators, instead of going out and over communicating, letting their LPs know exactly what's going on. Hey, interest rates are doing this, or we're having some trouble. We can't make our loans. Instead of doubling down and tripling down on their communications like they should be, like you do, like really the top operators do, they've decided to stick their heads in the sand and not communicating with LPs, and that really
they just disappear.
frustrates. Yeah, they disappear, and it frustrates the LPs, and LPs lose confidence and trust in operators. And I think it's going to have a significant impact moving forward because those operators now are going to want to raise capital again in the next cycle, and people don't forget. Yeah. And it's interesting with the internet, there's a lot of LP communities out there that are basically, they have their private, they don't even let any operators in, so they speak freely, and everybody knows which operators are the ones that are communicating, which ones are not. I think everybody understands we're going through some tough times, but it's the way you handle it and how you communicate with investors that I think goes a long, long way.
And two, it's when you look at this managing of expectations is really hard because people have different expectations, including the operators. And this comes back down to the format of how you present the opportunities and everything to get started. So if you're going to raise money from other people and you're going to work clearly defining how those things are going to look. So I know a lot of people are like, well, I want to get in. I want to raise money, right? They may be nervous, right? And I think that it's actually a better time right now because when we were raising money and everything, you had a lot of people that had only ever made money. So after 2018, 80% of all the funds in the self-storage industry, in my industry, had never been in storage before. Right. 80%. It was their first time. And this was at a time where rates were rising at not only double digit, but in a lot of cases, 20% a year. And occupancy was at 96%. And so all of a sudden you had this mix of operators and LPs that they've only ever known not only up markets, but extraordinarily up markets, where today that's not true. And I think it's actually a great time to raise money and capital from people because we all know it's not perfect, right? and it's not going to be perfect. So it's like, what are we doing? What are the opportunities? And how are we going to go about this to have real discussions, honest discussions? And I know a lot of people were simply what I'd call chasing returns, operators and LPs. I think in today's environment, people are looking at it much better than they were 3 years ago.
Everybody talks about this idea that everybody was really focused on the returns, and they would compare two deals just by the returns. Well, this one's giving me 18%, this one's giving me 12. Why would I invest in your deal? And they really weren't factoring in this idea of risk. You should be looking at a risk-adjusted return, and you should be looking at the quality of the operator. And I think people are learning their lesson.
Yeah.
Because, like I said, 2 or 3 years ago, it didn't really matter. Even though we talk about vetting the operator, and that's really what you should be doing as an LP is finding out whether the operator has the experience, whether they have the expertise, whether they have the track record, whether they have the team, all those questions. 2 or 3 years ago, nobody cared, and it was like, what's the bottom line? How much money am I getting? I think today they're going back to basics and they're saying, okay, I better pay attention to who this operator is that I'm giving my money to, and do they have that expertise? Because it's no longer the expectation isn't that, hey, real estate doesn't go down, I'm going to make 20% a year no matter what. There's actually is risk involved, and you can lose your money. And if you don't do your homework on the front end, there's a good chance you will lose your money.
And every operator is different. Like, this is something that is really important to understand. We all have different mentalities, how we view the world, how we do things. I think it's really important if you're trying to get out there to get deals to be very clear on that, right? Like, I tell investors, probably not the best thing, but I'm like, you're not my first priority.
I love that.
The deal is. The deal is my first priority. So I will always not give you distributions, and I will always put pauses on everything else just to make sure the deal's okay. Because at the end of the day,
investors love that, right? When you tell them that, investors love it.
they love it. They love hearing they're not my number one concern. And so I don't get a lot of investors from that. But then I think after what happened was a lot of people realized why we would do that. Because for me, if I'm catering to make investors happy in the short term, I have to sacrifice long-term things, right? And I'm a value-based investor. That doesn't mean I'm right for everybody.
Right.
Like, I know that and I understand that.
But you're upfront about it.
But I'm upfront about it. And I'm like, listen, I am not for everybody. I am this because we are focusing long-term. Like, we do things that other investors weren't happy about, where we would take out our interest rates for 10 years and we would pay a higher interest rate. Or I'd pay for things in cash. Like, we had development land and things and we'd buy it in cash. And they're like, why aren't you putting debt? We would get a higher return if you got debt. And I go, well, I don't know what this approval process will look like, anything else. Now, hindsight, that looked good. But if that was 5-6 years prior, that wouldn't have looked good. If they went with somebody that did short-term debt, high financing, they would have made a lot more money than if they'd put their money with me. So I'm also very much recognize that. I think I was crafted through 2008,
right,
where I was scarred from it, right? We didn't lose deals or anything, but still, anybody that went through that, it was memory, right? So it's not for everybody because people have different things. So some people are really high risk tolerant. Others are low, right? Others don't need cash flow. Others want cash flow immediately. So when you're an LP and an operator, this is like a marriage, right? And you need to align with what you want. And when there's conflicts at that, when you think you have a safe investment, and all of a sudden you find out there was lots of risky things going on, now you're really, really upset. Yeah. And I think we've seen a lot of that.
And I think a lot of LPs also are now paying attention to things that, like I said, like a cash call provision or what that looks like, or even sort of indemnity provision. There's a lot of things that 2 years ago nobody asked about, and now they're starting to really scrutinize it because they're just realizing that it's not easy money. It's actually work. It's a business. You're investing in a business, and it's like you said, it's not an ATM. Mm-hmm. And so if you're an LP out there, I would just really implore you guys to do your due diligence on the particular person who's raising the money, find out what their level of experience, how long they've been doing, what their team looks like. Because the other thing is, what's their expertise in that particular asset class, right? I mean, you're like world renowned in the self-storage space. If you came out with a project about tiny houses, I don't know, like maybe not, right? But I'd at least hope somebody on your team is an expert in tiny houses because it's very, very nuanced.
Exactly.
If you're a multifamily guy or gal, you may not know much about self-storage. A market's another big thing too, right? You might know the Dallas-Fort Worth market really, really well, but now this deal's in Ohio. Yeah. It's like, well, what do you know about Ohio? Who on your team knows about Ohio? What are your relationships in Ohio? So all these little questions are key before you write that check, because once you write that check, you've got absolutely no control over things.
Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class when dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process. They are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
Now, what would you tell operators today that are seeing opportunities? They see the market. They're like, hey, we have a good chance. I want to go out. I want to get in the game. I want to be buying deals. But I obviously don't have the money that it takes to be doing this. I need to raise capital. What are the pros and cons? What are the do's and don'ts for those that are out looking at getting investors and raising capitals right out of the gate?
Yeah, so the do's and don'ts, it starts with understanding. So this is a do. Do understand that you're in the business of issuing securities and needing to comply with securities laws. That's a big one. A lot of folks out there are raising money and they don't know that they're actually having to comply with it. They think they could just put together an entity, put a bunch of money into an LLC and buy the property. They don't realize that there's a bunch of regulations, and understanding what regulations are is important because that'll dictate what you can or cannot do, right? Some regulations allow you to advertise to the general public and some don't. And so it's really important for you to understand all the regulations. That's why you need an attorney like myself to walk you through that. But understanding that for most of us, for example, you can't go on social media. You can't come over here to an event like this and just have a booth and start selling your stuff. You just can't do it. You just can't. You've got to have pre-existing relationships, for example. That's a big thing. So there's just a lot of regulation. I think another one that people do, a big no-no, or which I see a lot, is this idea that I kind of want to not worry about the securities laws, and so I want to structure this as a joint venture. That's one of my favorites, right?
Yeah.
People are like, hey, it's a small deal. These are all friends and family. I'm just going to do this as a joint venture. And people don't realize that you don't get to make that decision, right? Whether it's a joint venture or it's a securities offering, it is what it is. The facts will dictate one or the other. So it's just really important to educate yourself like most. I think that's what this is so amazing about this conference is that you can educate yourself, but really understand that you are in the business of issuing securities, and you're either going to have to register that security or you're going to have to find an exemption. So it's really important to educate on what you can and can't do.
For me, that's actually a relief. Like a lot of people, you may be like, that's really scary to me, right? I'm scared about it. But for me, it's actually a relief because I'm like, I don't need to know. Like, I don't want to know. I don't want to say what I'm going to do, what I'm not going to do. I'm like, that's your job, right? Like, I don't, you tell me and I'll just do it.
Yeah.
So actually for me, it's a relief because I'm like, just tell me.
What can I do? What can
I do and what can't I do? And we will then go do that. So instead of worrying about, I need to know this or I have to figure this out, I don't. I pick up the phone and I call you.
Right.
If I'm looking at doing something, what do I need to know? What can I do?
Right.
I'm not doing the documents. I'm not drafting it. We send my social media posts over to his firm and say, can we say this? Can we put this out? And they either say yes or no.
But we have a relationship. So a lot of folks that have never done this before, they might start the process of doing stuff. They may already be on social media and advertising and not realizing it. Then they call me and say, hey, I'm ready. And they've already been advertising. They've already been generally soliciting, which is a no-no in a particular exemption is what we call it. And so now we no longer can use that exemption. So if you had called earlier, or if we had a relationship, we know that we could do this exemption, but you can't do this, this, and this. But if you called too late, then it's like, crap, you've already advertised this deal, so we're not eligible for that. You're going to have to do this other exemption, but there are other restrictions in that one.
So, true story, I was actually listening to, I think it was either you or Bethany, one of you, I can't remember, and I had done my first raise. And after what you guys were saying, I went back to my attorney and I'm like, hey, so I don't think we can do this. Why are we doing this? And he was like, looking at it, and I'm like, it's illegal if we do it this way. And I could see him shuffle around the papers. And he's like, let me get back to you. And then I heard back from him and he's like, we can't do this. We have to restructure a whole bunch of stuff. And I immediately was like, okay, hold on. And I called you guys, and then we had to go back through not only restructure, but I had to do all these edits, everything else like that. Now you may think, oh, AJ, well, that's your fault for using, some attorney that was your friend or whatnot. This was one of the top attorney firms in my area. The attorney was a great attorney. In fact, he was hired as I think the head attorney by the state. But the point was he didn't do securities. Yeah. And so I think it's really important to know that when you're doing this is a very specific thing. And I don't want to know.
Right.
I literally don't. And I don't want to even try to do it. So that actually, to me, makes it easier. As long as you have the person that exactly focuses on this niche. Yeah. Because you don't, like you mentioned, you don't get to make a choice whether you're doing it or not. Right. If you ask for money, you are already in the world. You're doing it. It's the results that will matter.
Yeah, and you just got to remember when it comes to attorneys, it's very similar to the medical field, right? So you can go see a generalist, right? A general practitioner. If you've got some ailment, you're going to go to a general practitioner. But if you have a problem with your knee, you're going to go see a specialist, an orthopedic surgeon. If you have a heart problem, you're going to go see a cardiologist, right? So it's the same thing with lawyers. We all have our specialties. And so if you have a heart problem, you're not going to go to your OBGYN and figure out, what's wrong with my heart, or you're not going to go to an orthopedic surgeon. So yeah, it's very important that somebody may be, I consider myself, I am one of the top, but I don't know anything about real estate law, for example. I'm not a real estate attorney. I'm a securities lawyer.
Yeah, I have a real estate attorney on staff, which you guys know, you guys work with. Yeah. And we use him, but then we use their firm to do this, and it's separate. Yeah. And I think as someone raising capital doing real estate, this really comes down to a lot of people are overwhelmed. I don't know this stuff. I don't know what to do, but you should actually welcome that. I know I don't do title. I know I don't do loans. I know I don't do these things, and that's okay. It's about building that team around. And once I think I realized that, it was like, wow, I can really do anything. It was so empowering to me, which a lot of people are like, it's so overwhelming. I guess to me, it was just easier to understand that I'm an idiot. And I'm like, no. So I just get other people that aren't, and now I can do anything, right?
It's a business, so it's like you're either the quarterback. Think of it as the quarterback of the whole thing. So you have a team. So you have a team of brokers that find you deals, but lenders who are going to lend you the money, the transactional attorneys, securities attorneys, maybe an asset protection attorneys to help you structure it. So your job is to go find those people and put the pieces together. It's not your job to actually know the specifics and be a technician of everything. You just need to know the right person and then manage that whole team and make sure they work well together.
So now in the landscape that we're seeing today, the coming up 6 months, right, we've got a lot changing in the world. And I think we've already mentioned that we've already seen this change. I think we're seeing owners that are being forced into decisions. And we're also seeing owners that are just done. They're like, I'm done. I've been holding on. We have capital markets that are changing. Banks have readjusted. The chairman really said it best when the path is clear. And I think a lot of people are saying, the path is clear. We're figuring out the path to move forward, lower interest rate, everything else. Moving forward in this next 6 months, how are you looking at the raising capital world? What are the things that you are seeing and that you think people need to know about in this very quickly? We're moving into a different cycle. A whole new cycle.
And I think there's I think from a capital rate, there's a lot of opportunities because all of those operators that took out these bridge loans, those were all in 2021, 2022, some in 2023, but basically 21, 20, and these are all 3-year loans. So those are coming due now. Yes. This is we're in the middle of that, come to Jesus standpoint where they have to make a decision. They were holding off as long as they could, hoping that interest rates would go down and maybe that'll bail them out, but they're getting to the point where, hey, that loan is up. And the question really in my mind has been, and I kind of got a little bit of an answer this week, but what's going to happen? Are banks going to want to take over those? Are they going to foreclose? Are they going to look at other stuff? And it sounds like I had a James Eng, who's the national director of Old Capital, who's a big lending brokerage. He was telling me that a lot of lenders they don't really want the properties back. So they are kind of doing a little bit of extending. I call it extend and pretend. Yep. Where as long as you've got enough money that you can make the payment, they're starting to work with borrowers. They're starting to say, okay, I'm not going to forgive anything, but maybe if you're behind a little bit, maybe we'll capitalize and get the loan. Maybe we'll do some kind of a loan modification, maybe extend it for one more year. And then hopefully by a year from now, maybe rates have dropped 2 or 3%, who knows? And then you can refinance it and the property can do well. But I think there's a lot of opportunity, and that's what I'm starting to see is people appreciate that, seeing that there's all these, it's really distress, right? So somebody's problem is somebody else's opportunity.
Yeah.
And so I think people are starting to put together funds with the anticipation that, in the next 12 months, all these loans are going to be expiring and they're not going to be able to refinance or get a new one. So the question is just how well they're going to be able to negotiate with the bank, or is the bank going to want to have somebody come in and rescue it and get some rescue capital?
Where do you see people getting their capital from?
Most of my clients will get it from actually just really from mom and pop investors. So most of the LPs in my world are literally mom and pops. They're writing $100,000, $150,000 checks. They're not big institutional players because obviously that's another source of capital. Family offices, big institutions. But in my world, for my clients, they're raising it, which is probably one of the reasons it gets harder and harder to raise because a lot of LPs are concerned. They see all this stuff. The recession might be coming. I don't even know if I'll have a job. So they're tightening up a little bit, which makes it a little bit harder for capital raisers. But the other thing I've seen a lot, AJ, and you probably know this too, is like a lot of the institutional players are coming back into the market.
Yes.
I was having a conversation, I think, with Kenny probably 18 months ago, and the institutional guys were out. They were trying to fix their balance sheets. They were trying to figure out how they're going to shore that up. Well, now they've fixed their balance sheets, and they're now coming back into the market, and they're buying a lot of property right now. So, which makes it a little bit tougher too for some of the guys because now you're competing with the institutional investors as well.
Last thing I want to hit on here before we wrap things up, accredited investors.
Yeah.
Is that changing? There's been so much talk over the last 6 months. So first, let's hit on what is accredited investor? What does that mean? Why is that important? And then, is that going to change?
So an accredited investor on an individual side is anyone who has $1 million in net worth, excluding your primary residence, or you have earned $200,000 the last 2 years with a reasonable expectation of earning $200,000 or more this year. And if you're married and you want to combine that, that number goes up to $300,000. And the reason it's so important for you, AJ, and a lot of capital raises is that some of the exemptions that we were talking about earlier, right? You either have to register or find an exemption to go raise money. Sometimes they'll limit you to only being able to take accredited investors only. So it's really important for capital raisers to know, number one, what exemption we're using, because some of them will only allow accredited investors and some will allow non-accredited. And so there's been a lot of talk over the past, actually, I've been talking about this, I think, for a couple of years. There's a lot of talk of changing the definition because people feel it's unfair to use financial wherewithal as to whether you should be able to invest. I mean, how many of you know here that there's a lot of really, really smart people that just don't have any money, and then some of the dumbest people in the world have more money than all of us put together, right? So there's an argument to be made that financial wherewithal is not the one. So people are really advocating for some kind of an exam to be taken to show that you are sophisticated enough and be able to have access to some of these investments. Because honestly, what AJ does and what a lot of my clients have, they're just amazing opportunities that just aren't available sometimes to non-accredited investors. And that really is sort of unfair. Like, why should I be limited just because I don't have $1 million? These are great opportunities. I can invest in Apple. Why can't I invest in a self-storage deal? So there's a lot of rumors that they're going to be doing two things. One is they will be allowing some kind of a test, which I think is coming down the pipe. Actually, there's a bill in Congress that just passed. It passed the House last year, and it's just kind of stuck in the Senate committee, but it'll probably pass next year, that will allow you to become an accredited investor through a test, like an actual test that can really figure out whether you know what you're doing or not. However, I do think that the $1 million mark is going to go up too. The limits to being an accredited investor, I think, are going to be going up. $1 million threshold was done in 1982. Which is a while ago, 40 some odd years ago. So just adjusted for inflation, that number's 3 million. So I do believe they're going to raise the limits of an accredited investor for you to be automatically accredited from $1 million to 3. But you're also going to have now the opportunity or the option to go take an exam or something. That's in the works. It's not law yet. Like I said, there's several bills in Congress. There's already an SEC rule that's kind of proposed for that. I think in the next 12 to 18 months, you'll see that come along and you'll have some really big changes in that world.
So we got a lot coming down the pipe into next year and a lot in our world that is changing. We got interest rates. We've got the overall investment landscape moving into this new cycle. We have a new administration that will be coming up. We also then have changes in accreditation laws, everything else. I think it's important for everybody to remember when there is change, there is opportunity. And I think you guys making sure that you have the right team around you put you into place to get opportunity that others can't because they're not prepared. And you are obviously a key member of our team, but it's so important because when you have those key players on there, these problems that you see that are complicated, you can't do, they just evaporate and you don't need them. And then you feel way more empowered and you can see opportunity and take advantage that you didn't even know existed. So thank you for coming on.
Absolutely.
Thank you for telling everybody what you're seeing out here and helping everybody out.
Thanks for having me, AJ. Always good to be here with you.
Appreciate it, man.
All right, man.